Everybody, welcome. Welcome to another great Wealthy Winning Wednesday. Woohoo! That's today. We're ready to rock and roll. Who's with me today? All right, we have some brokers joining us today. Thanks for tuning in. Please let us know where you're joining us from. You can just go ahead and type in the little chat bar right there. Today we have an excellent session talking all about accounting, banking, bookkeeping, all those fun topics. Should I say fun, right? Some of us don't think those topics are fun, but we still need to know them before we outsource them, right? So you can supervise and make sure that whoever you've delegated that to is doing what they're supposed to do. And then you also need to be able to read your financials and understand what it means. So let's go ahead and get our slides up and get started here. Welcome to Module 4 of Drive Profits to the Max, Accelerate Your Real Estate Brokerage, and Push the Needle, right? We're not just moving the needle, but we're pushing it forward because we are purposely compelling and driving forward. Welcome. Thank you for joining us today. We appreciate that you have taken time out of your day to work on your business instead of simply in your business. We know that's very difficult for us real estate brokers because we are often dealing with agents, we're recruiting, we're putting out fires on crisis, we're having to make sure that all the bills are paid and manage all the overhead. And there are so many hats we wear, and many of us are still in production, actively selling real estate or managing properties. So it's often hard for us to carve out that time to work on our business. And so my hat's off to you today for doing that. Awesome. And who's ready to rev up their engine? Start your engine and let's get going here. We are driving profits. This whole series of Drive Profits to the Max is part of our masterclass series. We have 3 of them, which is Scale Up Your Brokerage, Be the Boss and Dominate Your Market, which is all about innovation, and Drive Profits to the Max. So we hope you enjoy our masterclass series. We're learning how to maximize profits, which is the number one goal of any and every business, is to maximize profits. We are in business to earn a profit. Yes, we help people. Yes, we mentor agents and make a difference in our communities. But without a profit, we can't even stay in business. So today we're learning not just how to be profitable, but how to understand if we're profitable and make adjustments to make sure that we are as profitable as possible. And it starts strong with your custom dashboard, right? Just like the dashboard on a car. MBA Broker Consultants is here to help you with any question, concern, or problem that you have in your real estate brokerage, whether you need questions answered, you need some advice, or you just need a sounding board of somebody to run things, over, not run over, but run through things with. We're here for you. So please pick up the phone, give us a call, send us an email, or we're available on Facebook. All of those are great ways to get in touch with us. Our goal is not to just play the game, but change it in a massive way. Who's with me on that goal? Woohoo! We're going to change the game of real estate brokerages. Our session today, our module is session number 4, accounting and banking. We're also going to talk about bookkeeping. So it will be sort of a basic lesson about accounting. And as you know, I earned my MBA degree I actually have accounting experience from way back. I actually took 2 years of accounting in high school, 3 college courses the first time, as well as when I went back and got my bachelor's in real estate and my MBA degree, even more accounting courses. So I hope to share some of those tips with you today that you can benefit from and keep building your business strong. And again, I am accredited from the Association of Accredited Small Business Consultants. I'm an ASBC, which is an accredited small business consultant. Our 4 sections we're going to cover today are financial statements, accounting, bookkeeping, and banking. So, who's ready to get started? Oh yes, we do have an activity workbook. So I'm going to go ahead and share the activity workbook with you right now. Let me find that in here. Okay, it's called Drive Profits number 4. I went ahead and shared today's worksheet, which is part of the whole workbook. So please let me know if you received that. You can just go ahead and type into the chat. Let us know that you were able to pull that up and follow along with today's presentation. You will see there's 3 sections to it. First, we're going to go over today's topic, which is the module, and that's the first few pages. And then we will have a self-analysis for you to quiz yourself, a little test, and then some books and resources for the going into the future. Accounting and banking. This is a topic that often we don't discuss as real estate brokerage owners, and it's something that's often overlooked. We talk a lot about revenue, production, and there's not as much of a focus on what that means for the bottom line profitability, and more importantly, how do you determine if you're profitable? Well, your financials, and it all comes down to your accounting. So today we will share some basics with you. Hopefully this will be, you'll learn some new things. And then next module, we'll dive deeper into the accounting. And we'll talk about that more as we get there. All right, so buckle up and we're heading in the right direction. Yes? That's what it's all about today, is what direction are you headed in? And your financials will tell you whether you're going down the path of profitability or the path of loss, whether you're scaling and growing your business and increasing, or whether you're falling behind in your year over year. So let's start with a little poll here. And our poll question is, how often do you review financials? I'm going to go ahead and put the poll up here. Okay, so the poll question is, how often do you review your financials? And the answers are A, I print and read them weekly, or maybe online weekly. B, I study them monthly. Or C, only when it's tax time. Hopefully your answer is not C, because if you only review them once a year, you're not going to understand what's happening day to day until it's too late to change it and you're on the wrong path. So A, print and read weekly. B, study them monthly. Go ahead and make your selection. We'll give you a moment to choose one of those poll answers. Okay, let's keep going on here. Financial statements. Financial statements to me are like the rear view mirror and the side mirrors. Because when you look in the rear view mirror, you see what's behind you. You see where you came from. Financial statements are not forward looking because they're reports about what's happened in the past, right? So key takeaway point is financials reflect the past. They reflect what happened and how you got to where you are at today. Now we're talking about driving your business forward, but to drive your business forward, you have to know what happened in the past because it will tell you what path you're on. So that is the value of examining, reviewing your financials and understanding them. There are 4 critical financial statements that you need, and we'll go over each of these in a little more detail. But the first one is your income statement. Now, a lot of us small mom and pop shop, small business owners, we refer to that as a P&L, profit and loss. In the accounting world for a corporation, that's usually referred to as your income statement, but it means the same thing. I really don't like the term profit and loss because that implies that a loss is possible, and we really don't want to have a loss. It should be profit only, right? It should be income, so we're going to call it the income statement. Next is your balance sheet. Your balance sheet shows it's an equation of how much you owe versus how much you own, and then your equity in the company, which is the next item, your owner's equity statement. And then lastly, we have your cash flow statement. And your cash flow statement does not necessarily mean profit. It just means where the money came in and where it went out. So let's take a closer look at these. Now the income statement, you can see I have a sample here. And on my sample, we have, I'll turn on my screen sharing in just a minute so you can see that. We have revenue coming in, cost of sales going out. That leads to a gross margin. And then we have our operating expenses, which are our fixed costs and overhead, and that leads to net profit. So let me go ahead and turn this on here. And I'm going to pick red for my pen. Okay, so at the very top here, we have our sales. That's the income coming into the business. That's our production. And in this example, we just use a random number, $1,000. And so that's 100% of our revenue, right? And revenue can come from multiple sources, your sales transactions, referral fees, property management. Perhaps you charge your agents a monthly desk fee. You have your transaction management fees, consulting fees, BPO fees, and there could be other sources of income as well. The bottom line is you don't want to have just one source of income. You need to have a broad, strong base that's a foundation for your company. Because if you have just one source of income, what happens when the economy shifts gears overnight? Your income goes downstream. So you definitely want to make sure that you have a nice solid base for your company. Next, we have the first type of expenses, which are known as variable expenses because they vary with your transactions, and we'll call those COS, which stands for cost of sales. So your co-op buyer broker, your agent splits, your referral fees, your transaction fees, these are all costs that the company incurs at the time of a transaction when they're paid for a sales transaction. And in this, we said, we just put a random number, 900,000, which seems like a big number. It really is. But if you're doing a 90-10 split with your agents where they earn 90% and you keep 10%, that's what this number could be, right? Your cost of sales could be 90%. Now, Hopefully it's not, and hopefully you're doing other things to recoup some of that. But that's where it could be if this is how your business is set up, which is why it's so important to start at the beginning and how you set it up. Okay, that leads to taking the sales, subtracting the cost of sales leads to your gross margin. So your gross margin in this case is just a simple subtraction, is 100,000. That's 10% margin. That is a very low margin. You know, definitely too close for comfort for me. I would want to see that number upwards of 30%. Next, we have your next item that you're going to subtract are your operating expenses. And we call those fixed costs or overhead. They're not fixed in that they're the same amount every month, but they're fixed in that these are expenses you have to pay every single month or year, regardless of whether you earn any income or not. So that's, for example, your manager's salary and benefits, your staff's salary, your building lease, whether it's a lease or a mortgage, you pay that every month, regardless of how much closings you have, how many closings you have, regardless of your production, regardless of your income, regardless of your sales, you pay these every month. Your equipment lease, if you have a printer, utilities, maintenance, your marketing, your training, tech tools, office supplies, your insurance, your professional fees. Oh, don't forget that. Your realtor fees, MLS fees, and your risk management. So all of these are expenses that you would incur no matter what. Now, in this example, we have $65,000, which is probably not too unusual. And again, we're talking about a year, right? For a year. And that's 6.5% of this number up here. So operating expenses, 6.5%. That's actually not too bad of a number. And then we get down here. We subtract the operating expenses from the gross margin, and we get our net profit. Now, mind you, this is net profit before you pay taxes. It's called EBITDA, which means earnings before interest, taxes, depreciation, and amortization. Okay, so in this case, we just did a straight subtraction, and there our net profit is $35,000, which is 3.5%. This is a very, very low number. Now, what do you have to do from that net profit? Well, that's the profit for the business. You still have to pay your taxes, your interest, your depreciation, amortization. All of that comes out of that number. Now, hopefully you yourself as a brokerage owner, you're getting paid up here a manager's salary plus benefits. But even if you are, this number is, going to be your bottom line. So is that how much you want the company to make? And then again, of course, taxes have to be subtracted from that. So by the time all that's done, maybe it's down to $10,000. So you have to ask yourself, am I profitable really based on the time and effort that I put into this business? If not, then we need to look at how to up this number. We need to look at how to lower this number, the cost of sales, up your sales, lower your cost of sales, which raises your gross margin, how to decrease your operating expenses and increase your net profit, your bottom line. And all of those things we will be going over in the next module because it's very detailed, and we'll be showing you how to squeeze more profits based on the income statement. Okay, so I hope that made sense for everybody. I hope that is, turn the whiteboard off. I hope that it is helpful to you in learning how to read your statements and not just read it, but understand what you need to do to be profitable and to drive your profits higher. Next, we have our balance sheet. And our balance sheet is comprised of three things. Got my little whiteboard here again. All right, there we go, my red marker. So the three things on the balance sheet are, first of all, your assets, which are things like cash in the bank, equipment, buildings you own. Those are things you own. And then your liabilities, which are the debts that you have incurred that you owe, and then your equity. And equity, we'll go into equity a little more in detail in just a minute here. But if you're not familiar with the balance sheet, you can think of it as your house that you own, right? So say you own your own house. Woohoo! You bought your house and it's now worth, we'll say your house is worth $350,000. Yay! So we're just going to put that down here. And we're just using a house as an example, right? But this is how your assets and liabilities are calculated for your business. So that's the value of what you own. But now you have a note, a mortgage payment. How much is that? Well, let's say that's let's say it's $250, just to make our math simple here. So that's your liability because that's what you owe against it. And that means, what do you have left? The difference between the two is your equity. And so that's $100,000 in this case, right? So you can see there we go, $350,000. And then if you add up the $250 plus the $100, again, you're going to have $350 here as well. Okay, I'm just drawing it in. Okay, so these two balance, right? So if you owned a house, it was worth $350, but you owed a mortgage on it of $250, then you would have equity in your house of $100,000. It's the exact same thing with your business. You take your assets, which are your cash equivalent, fixed assets, anything that you own, you subtract what you owe, and that's what you come out with, your equity. Now, which one of these columns or items in the column is good or bad? Assets, yay, those are good. Liabilities, not so good. Because the lower your liabilities are, the bigger your equity is. And that is the goal, is to increase the equity. So the equity shows how profitable you have been over a period of time in accumulating profits to the business. That's the simplest way to say it. Any questions? Any questions, please let us know as we go along. We're going to go ahead and erase the whiteboard, and we're going to dive a little bit deeper into the balance sheet now. So just to recap, assets are what you own, regardless of how much debt you have on them. Liabilities are what you owe. So if you have assets of, as we had in our example, $300,000, you have a liability of $350, you have a liability of $250. That's all good. But what happens when it flip-flops? What happens when you take out more debt than you have of assets? So if you owned $350,000 worth of assets in your business, but you owed $450,000, then you'd be upside down, not good, right? And then you would have no equity in your business. And we can't have a negative business. All right, so let's just explain the terms just a little more. The balance sheet is defined as items or property owned having economic value. And these assets are expected to yield a benefit to the business. That is the whole point of the assets, is the assets are working for the business. Your cash is being used to purchase things, and those things are also assets, and you use those in the course of your business to bring a return to the business. Now, there are different categories of assets. Current assets, which are things like cash in the bank, non-current assets, which are things like real estate, or maybe a fixed asset is real estate that you can't instantly turn into cash. And then you have intangible assets, which are things like your proprietary ideas and tools that perhaps have value or have merit in the marketplace, and you can put some type of a price on those, right? So that would be like maybe a patent you have, or some intellectual property or something like that. Okay, so that's your balance sheet. On the liability side, those are the debts you have on the business, purchases you've made on credit, loans to the business, or somehow debts that you've incurred. Now, in a real estate business, you really should not have many liabilities unless you've purchased your building that your office is in and you have a mortgage on that. Liabilities are not good because they reduce your overall equity. So you want to use your liabilities smartly and make sure that if you are going into debt, that you can have an adequate return on that, and that you can leverage that to earn more equity in the company. But what I do see is many times in real estate, agents or brokerage owners will get into debt thinking that if they just buy this or buy that, they can make the business go better. And it doesn't always happen that way. Our business is pretty much a cash business. We only get paid for performance in sales and property management. We get paid at closing or when we collect the rents. So there's really no reason to have a lot of accounts payable and accounts receivable and those types of accounts. Now, in liabilities, you would have current liabilities. So those are perhaps a credit card that you have, or longer term liabilities, and current liabilities may also be your accounts payable, because you're going to be paying those out to people. It's money that you owe them that they've already provided a service for, and you're still in debt for it, which I already admonished. Don't do that as a real estate brokerage owner. And then you have longer term liabilities, might be a long-term loan, such as a mortgage on your building that you're in. Okay, so that's liabilities section. Next, we have your owner's equity. Now, I'm going to explain owner's equity two ways. The first is if you're a sole proprietor, or if you're a partner, or community property like a husband and wife. In other words, you're not incorporated. And then the second way we'll talk about if you're incorporated. So this is the easiest way, is not a corporation. So I'm going to go ahead and turn on my little whiteboard here again. Get my red ink pen that I love to draw with. So it starts out with your owner's investments, right? Which is the money that the start capital you initially put into the company, and then you add your net profits to it. And then the profits do keep accumulating, right? Until you either lose money, in which case it reduces your equity, or if the owner withdraws money from the company, that will reduce the equity as well. Okay, so investments plus profits minus losses minus withdrawals equals the owner's equity. And that's how you arrive at the owner's equity on your statement. Now, let's go on to the next one, which is a little more complicated. This is the stockholder's equity, if you have stock. And for these types of corporations, I would not recommend that you do your own bookkeeping, but to pay somebody to help you with accounting and bookkeeping, which we'll talk about in just a minute, because it gets into some more complex areas. And if you put it in your QuickBooks wrong, all of a sudden you're out of balance and you don't know what happened. And then you can't read the financial statements. So let's talk about how to calculate the stockholders' equity. So the first is to start with your paid in capital, right? That's what was paid into the business to start it up by the partners or by the stockholders. And then you're going to subtract your treasury stock, right? So what's paid out in stock. And then you're going to add in retained earnings. And we'll talk about that in just a minute. And that equals your stockholders' equity. Okay, so your paid in capital, that is the amount received by the corporation when the stock is sold and when it's issued. The treasury stock is stock from a corporation that was previously issued and then repurchased from the shareholders. So for example, the stock was given out and then it was repurchased again by the company. And then you have retained earnings, which are the accumulation of profits and losses throughout the life of the corporation, reduced by the cash dividend payments. So you can see there are some additional terms and additional types of calculations here. And definitely we need some professional assistance with this. So we'll talk about that in just a minute. But let's go back to the 4 documents, the 4 financial statements that you need. One of them was called a statement of stockholders' equity or owner's equity. And we just saw how to arrive at those, but they summarize the changes from the beginning of the accounting period to the end of the accounting period. So basically it says your bottom line of your equity of how much you net own in the business is at the beginning starting date, January 1, at the ending date, December 31, and here's how much it changed over that time period. Okay. Everybody learning a lot? Okay, well now we got our statement of cash flows. Now you might think this is the great part because I'm going to find out about my cash. Well, it's not really as great as you think it is. It doesn't really tell you if you made a profit. As a matter of fact, this statement can be quite misleading because it can look like you made a lot of profit because you see a lot of money coming in. But unfortunately, if the money came in and went back out again, then you didn't earn a profit. So it just details where your main sources of revenue are coming in, where your main sources of expenses are going out. Right. So the official definition is the statement of cash flows details where all the cash in a business came from and where all the cash went to during a specific accounting period. Now we're going to take a closer look. Okay, go back. Not now. In the next module, we're going to take a closer look at these financial statements, and we're going to look at how to determine whether they're, well, basically what they're telling you. First of all, how to normalize them and understand them, and then how to use them to be more profitable by seeing in the areas that perhaps your business is lacking or weak in, and the areas it's strong in, and how you can bolster that success. Okay, now we're going to switch gears a little here, not too much, but we're going to talk about accounting. Accounting, I call that the windshield and the windows because it gives you a clear view of where you're going. The financials are the rearview mirror looking behind us, whereas accounting, we're going to be looking forward. We're going to use those financial statements, right, to look forward. So accounting is like the windshield. The 3 areas of accounting that we're going to touch on today are cash versus accrual basis, receivables and payables, and that good old accounting equation, which we actually already saw on the balance sheet. Now, I know this is an area that is confusing too many real estate brokerage owners, and how do I say this? It's not, I know many of us did not go to business school and we didn't take accounting, but this is a confusing area, and for what we do, it doesn't have to be, and I'll share why on the next slide. But basically, the cash basis of accounting means that you recognize your revenue when you actually receive it, not when it's earned, and you recognize your expenses when they're paid, not when they're incurred. So an example of that is, just to use a real estate transaction, you close escrow. At the escrow or the closing, the settlement, as it's called in some states, you incur, not you incur, but you receive a fee, and you get paid that fee right away. So you put that in the bank, and that's all good. You counted that, right? So you recognized it right when you received it. That wouldn't affect the cash or accrual basis. But what happens if you are doing, let's say, REOs, and you have an account with an REO vendor, an asset management company, and they ask you to go do some work at a property. Maybe they ask you to turn on the utilities, and they ask you to do a trash out, and you spend your money to do that, and then you send a bill to the company. And when you send a bill, then you are hoping to get paid for that, right? Now, the difference between cash and accrual basis is when you have a cash-based business, you're actually going to recognize that revenue when you get paid. So if you do the work now and you don't get paid for 3 months, you actually don't put it in your books until you actually get paid 3 months later. Or if by some chance the company never pays you, which is always a risk when you're billing companies, then that will never be earned revenue. Okay, so on an accrual basis, you recognize revenue when it's earned, not when it's received. And the same thing with expenses, you recognize them when they're incurred, not when they're paid. So let's take that same example of the REO account, the asset management account. You've done the work. Now that you did the work, you send them a bill. In the accrual basis of accounting, you would automatically recognize that revenue. So say your bill is $2,000. In the accrual basis, if you did the work right now, in your books, you would have earned $2,000. You didn't receive payment for it yet, but you actually earned it according to your accounting books if you're on the accrual basis. Okay, and then you send them the bill, and then they pay you 3 months later, and then that's when you can, balance out that account, because you're actually receiving the money that was already incurred, or the revenue that was already counted in your books. So as you can see, the accrual basis is a bit more complex. It requires more accounts, but it is the standard for businesses. It is a standard for corporations. And if you are going to be writing a business plan, if you're going to be getting a loan from a bank, bringing on investors, most likely you will need to switch over to the accrual basis of accounting. And it does throw you off a little bit, because it's not what you expect to see, because you're going to see income that you actually don't have the cash for in your bank yet. And you'll also see expenses that you've incurred. You went out and have an expense, but you haven't actually paid for that yet, right? So that's the difference between the cash and accrual. And if you have any questions, just let us know in the chat box, or you can reach out to me at any time. I'd be happy to talk to you a little bit more about it, or you can talk to your bookkeeper or your accountant We love those financial professionals who are on our team, right? So again, the cash versus accrual, the things that are affected by the difference between them, your accounts payable, accounts receivable, your bills received, and your invoices billed. Those will be some of the main things that are affected. And considerations would include your annual billing cycle, your fiscal year versus your calendar year. And then again, as I mentioned, if you're going to do something at a corporate level, you're going to be using accrual. Now, the trick is cash is simpler and it's easier to deal with, but once you convert your accounting system from cash to accrual, you can't go back, right? You have to stay with an accrual accounting system. Now, let's jump into accounts receivables and accounts payable. And I mentioned those before, but accounts receivable is when you've sold somebody a product or service and you have yet to collect that money from them. It's on the books as a receivable. Now, in real estate sales, transactional sales, we don't have any accounts receivable. In property management, we generally don't have accounts receivable either. In the other example I mentioned, where you could be working for an asset management company and they require you to foot the bill for everything and then send them your bill and expenses for reimbursement later, that would be an accounts receivable. So you've sold something to somebody, you performed the work, but you haven't yet received payment for it. Now, accounts payable is the opposite. That's money that you owe to somebody. For example, maybe you bought a new printer, copier, and cool new equipment, and you haven't yet paid for it. So that could be an accounts payable. So it's a debt that you owe that you've received the service for, but you haven't yet paid for it. And then the general ledger is it's the system where you see all of these accounts and things, your accounting system. And we'll take a look at some T accounts next. So we're back to that good old accounting equation. Assets equals liability plus owner's equity. And we saw that back in the balance sheet, right? So assets equals liability plus owner's equity. Now we have bookkeeping. I call these the windshield wipers. They're clearing the view for you, right? Whereas accounting is your windows and bookkeeping is going to sort of clear the windows for you. Now let's take a little poll here. Do you have a bookkeeper? And the answers are yes, we outsource. That's A. Or B is yes, we have an internal employee. Or C, no, I do everything myself. Now, there is no right answer to this. However, all right, poll is up and ready. Go ahead and take a look at that and answer. However, if you do everything yourself, then it might be difficult for you to wear all the many hats you have to wear, including working on your business. It's probably not the best use of your time unless you're a very, very small company. So I do suggest outsourcing if possible. Make sure that your professional is licensed, bonded, and has some accountability built in. And then make sure that you have checks and balances in place where you are actually checking the books and you understand. And that's why we're explaining everything, so that when your bookkeeper gives you the books, you can look at it, glance at it. It doesn't take long, just a minute to look at it and see if everything looks okay. Now, if you have an internal employee, you definitely need to have checks and balances in place as well, because there is always a possibility of theft, internal, financial theft in your business. And it doesn't happen often, but it's avoided. And we're going to talk about this in one of our ending modules, but it is avoided by you being on top of everything and checking and making sure there are checks and balances in place. All right. Any questions yet? There's our little graphic for bookkeeping. We're wiping the windows clean to clarify our vision. We have a big vision, and it's time to implement. All right, the 4 things we're going to touch on in bookkeeping are the double entry bookkeeping, debits and credits, journal entries, and T accounts and balances. And you can see how this all ties back to the accounting and the financial statements. A double entry bookkeeping system is one in which every transaction or entry to a financial statement account requires a corresponding and opposite entry to a different account. Now, if the books are going to balance, you can never have a one-sided entry. That is the difference between using Microsoft Excel versus using QuickBooks or another accounting or bookkeeping system. Is that Excel, there's just one single entry, right? You're writing in what your expense is. Versus QuickBooks, it's going to have every expense is going to have 2 accounts. Every income is going to have 2 accounts, a debit and a credit. So just what are the debits versus credits? Well, debits increase your asset and expense accounts, whereas credits do the opposite. So credits increase liability, equity, and revenue accounts. So it records your accounting transactions, and debits must always equal your credits. So we have a journal entry here, and this is sort of what we call a T account. You can see the little T here, right? All right, I'll turn on my little red pen. Right, so this is the T. This goes across, this goes down, so that's what we call our T account, right? Makes a nice little T there. So in your T account, you have money coming in, money going out, and every entry has both a debit and a credit. The debits are always on the left column, and the credits are always on the right. It is a formal entry into a bookkeeping system. So your T accounts and normal balances, a T account, like what I just demonstrated, is a graphic representation or visual aid of a general ledger account. The normal account balance of an account is based on whether a debit or credit increases the account. So if a debit increases the account, the normal balance is a debit. If a credit increases the account, the normal balance is a credit. So you can sort of think of your bank account, right? When you put money in, it's credited to your bank account. When you use a debit card, right, it takes money out of your account. And the account we're talking about, of course, would be your cash account because we're talking about a bank account. So here's a little example of a T account. So we had cash coming in. Cash received increases the credit column. So therefore, that is a credit account, right? And on the other hand, payroll, when you pay your employees, is a debit account because when you pay your employees, it increases the debit column in the payroll account. So these are 2 T account samples. Now here we have a little bonus for you. Oh, let me go ahead and put the bonus up. Who doesn't like bonuses? Woohoo! Okay, I'm going to go ahead and put up, it's a sample chart of accounts, which we'll be working on this next week in our next module. Okay, so a chart of accounts sample. In the chart of accounts, you can see that there are different account names, and then the ones that are indented underneath those are sub-accounts, and then you have classification. This is a good example of a QuickBooks template that you could use for your brokerage, right? Here's the account name and the sub-account. Here's the classification. So it's basically a list. There's 3 columns. I'll draw a little line between the columns so you can see that. Right, so there's 3 columns, and so these are bank accounts, right here. Bank accounts, other current assets, fixed assets, and other current liabilities, equity, income, cost of goods sold, expenses, and these are all expense accounts, more expenses. And then we have other income and other expenses, which are not generally part of your tax reporting. So for example, maybe life insurance, maybe you have a PAC, which is a political action committee donation. Many of us do make those to our realtor associations. So for ones that are not tax deductible, it would go in the other column. It's money that actually the business did spend, but it's not going to be on your tax return as an itemized item in your, a deductible expense. So therefore it goes in the other column. Okay, so this is what you can use to give to your bookkeeper if they are not familiar with real estate brokerage operations, or your accountant, if your accountant maybe has a bookkeeper on staff who's helping you, or you might just hire a bookkeeper. Use this to interview and hire a bookkeeper who already is familiar with real estate brokerage businesses. Our businesses are a little bit unique. And if somebody's not familiar with them, it would be really easy to get confused. So anyway, always refer to your professional. This is just a sample list that I made it for myself for my own brokerage, which I'm sharing for others who might want to use this as a template to create your own list. And I hope you like it. Okay, our goal is to always hire professionals. This is what we just said, right? A bookkeeper, that's a first step. Next is your accountant, CPA, tax preparer, or EA, which is an enrolled agent. And those are the people who the accountant and CPA will help you work on your business. Tax preparer, EA, will help you with your tax filing. So 3 great professionals. They can all work hand in hand with each other to help you be successful and make sure that you are on track to make the most profit ever and to drive your profits, max profits, and push that needle forward. Lastly, we're going to touch on banking. I call this the squeegee window cleaner, right? Because it helps us get a clear vision. We have a little poll for you here, and our question is, does your state require trust accounts? I know most states do. So if you could just let us know whether or not your state requires a trust account. Yes. A is yes, we must follow the laws in establishing our brokerage trust accounts for our clients. Or B, no, it's informal here, that's not required. And I have to say, even if it's not required, it's probably a good idea, a best business practice. Or C, I'm really not sure what our state requires. And if you're not sure, it's a good time to call your state, realtor association and find out. They usually have information. I know here in California, the California Association of Realtors has a broker legal hotline, and they have a lot of great information on helping you set up your client trust account. Okay. Awesome. So banking is like clearing that foggy windshield. It gives us a clear view of the meters on our dashboard, right? So here we have, let me go ahead and put my little screen share on again. My whiteboard. So here we have your bank account. Here's your corporation. Under your corporation, you're going to have 2 bank accounts. One is for your business operations, And 2 is for your client trust account. Now, the client trust account is for money that does not belong to you. That's why you see it in red here. This belongs to other people. And who are those people? Your clients. So you cannot use this money because it doesn't belong to you or your company. This is the property of your clients. And I know in California, definitely there are a lot of very strict rules about client trust accounts, establishing them, monitoring them, reconciling, reporting. And so all of those rules need to be followed. And the bottom line is that there is a line here. I know my little whiteboard's getting a little sloppy here, but there is a big red line here between your business account and your client trust account, and you never want to commingle those funds. Now, in your business trust account, I actually recommend putting in several different types of accounts. Start with your income, and then you have all of your fixed expenses can go into another account that you pay monthly. Your taxes, right? We know we have to pay those, and we have our quarterlies due, and then our payroll should go in a separate account, and then donations or anything else can go into another account. Now, this is from the book Profit First by Mike M., which I can't pronounce his last name, but it's a really awesome book. I highly recommend you take a look at his book, and he shows how to break down your account so that you can always have a clear view and measure your income every month, your expenses, your taxes, and make sure that you're never falling behind in these. The main thing is you don't want to leave a bunch of money in your income account, because what happens when we see money there, we go out and spend it. So take that money every month, put it into different accounts or sub-accounts that allow you to make sure your bills are paid every month, and that you have, if you have any extra money, it's not going to frivolous things. Like, for example, you get a phone call saying, hey, you want to buy leads, it's $5,000 a month. You look at your bank account, you have $10,000, and you think, sure, no problem. But then the next month you have an unexpected expense that comes up, and now you don't have the money for it. So it's about just making good business decisions and best business practices. And that's why from your business bank account, you can have more than one account. Now, let me clear my whiteboard because it's kind of sloppy. There we go. Again, client trust account in its own separate account, and that's not your money. Now, if you're handling property management, you need a separate client trust account for your property management funds for the rents received. If you personally or your business own real estate that's rented out, properties that you manage, those do not get commingled with your client's property management trust account either, right? Because that's your own money as well. Okay, everybody clear on the bank accounts? Oh, as I just mentioned, property management, that's a separate entity. Make sure you have a separate corporation or business entity with a completely different name and a separate bank account. Now, why do you need a separate name? Because remember those negative tenants, those naysayers that you didn't rent to them because they had poor credit references, are probably going to go online and bash your company. So you want to make sure that you have a separate business entity for property management. Is your vision blurred, or do you have a clear vision of the future? If you want to know more, our company offers private consultations for your brokerage. We can make recommendations. We can put together a plan of action for you and help you get from where you are now, jump up to where you want to be. Maximize your profits. So your action plan today is do the math. Implement best business practices. Print and review your financials regularly. And most importantly, hire professionals on your team, right? That's your dream team. Now take a look at your activity worksheet. After the module, you will see a company analysis to test your knowledge and a checklist of some questions relating to today's module. If you need help or assistance or have questions on any of those or confused, please reach out, let us know. We are here to help you accelerate and push the needle of your company. Just to recap, today's topic was financial statements, accounting, bookkeeping, and banking. And we got a clear vision of where we're going, because accounting and banking are the windows that allow you to visualize the road ahead, know where you've come from and where you're going to. Any questions today? Oh, don't forget, at the end of your worksheet, you have a couple of great books that I recommend. And the two books today are Simple Numbers, Straight Talk, Big Profits from Greg Crabtree. And it's all about how to unlock your business potential by doing the math, right? And then we have Accounting Made Simple, which helps break down all of those accounting equations and just makes it really easy for you as a business owner to understand your financials. Don't forget, we have our masterclass for brokerage owners. Build your brokerage empire is all about starting, scaling, and succeeding. We have 12 courses with 24/7 online access. Each course has activity worksheets. We have bonus content and resources available for you. Again, great, awesome offer. And I'm going to go ahead and put the offer up because we do have a little offer for you. Okay, half price. There you go. If you want to take a look at that. Half price on Build Your Brokerage Empire. Let me go back to that screen. Take advantage with our coupon today. Only available to attendees. Be sure to dive right in once you subscribe. Make time every week to work on your business, not just in your business. Now, as you're thinking about today's topic, our next module will be financial statements. Today we learned what are the financial statements and what's on them, what do they mean, how to read them. In our next module, we'll take a really deep dive into those financial statements, and we'll learn how to look at our expenses and reduce those. We'll learn how to increase our income, and we'll use the financial statements as a guide to increasing our company's equity, increasing assets, decreasing liability, and making sure we have a really great owner's equity statement. Okay, so that's in our next module. So please stay tuned for that. It's time to rev up your engine. Okay, I know it's kind of silly. Thank you for joining us today, for taking time out of your busy, busy day to join us for Module 4 of Drive Profits to the Max, Accelerate Your Real Estate Brokerage, and Push the Needle. Keep going strong, brokerage owners. I know you're learning new skills. You're learning business skills that you didn't need before when you were just a real estate agent. You got to take off your sales hat and put on your business owner hat. And there's a lot to learn, a lot to know, but you can do it. You have the skills to succeed, and we're here for you every step of the way. So please keep working hard and remember to make time every week to work on your business, growing your business, and not staying stagnant. That's all I have today, everybody. Bye-bye. We'll see you soon.